Good morning. It's the 7th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital, but in transit right now. And the take, the power of doing nothing. A day or two after the market started cratering in March 2020, I remember getting a call from a well-known industrialist. He said he was selling into the market in sheer panic. From the sound of his voice, I was guessing that this was a large amount that he was talking about. I'm also guessing he must have lost a fair bit, though I don't know whether he reinvested, if he did, and then maybe laughed all the way to the bank. Now, the point is that a market fall like on Monday or on June 4th, 2024 can make the most seasoned investors shudder. After all, the stock markets have been running steadily up since COVID, as it happens. Right here on the core report, we've been arguing that valuations are increasingly stretched and more for some segments of the market than the other. Now, which is not to say that the markets will crash through the floor, but it is prudent to be prepared for corrections and stiff ones at times. And they're healthy too. The usual counter-argument at this point, of course, is that the earnings driven by company performances are strong and steady, and that's true. And second, that there is a near avalanche of funds flowing from investors who are pumping savings mostly by pulling out from bank deposits into mutual funds every month. Braver ones are even borrowing and investing directly in the market, including in derivatives. So that's true too. But Monday's 2,223-point fall was the first sign in recent years that we are not immune to global cues, which we to some extent thought we were. The reversal this time was because of the Bank of Japan, which raised interest rates, and institutional investors who were borrowing cheap yen earlier and investing in attractive stock markets, including, India, suddenly found it less lucrative to do so. And then on the other side of the world, in the United States, there is the artificial intelligence factor. The markets have been rising on the euphoria of AI stocks for the last year or so. But analysts are now questioning what AI will really deliver to its many users, including large corporations, and whether all of this investment is really worth it. And that's something that we've been highlighting here at the core report. Now, all of this makes the underlying proposition of a continuous bull market a little weak, at least for the moment. But actually, if you think about it, analysts have been questioning everything. Bloomberg, for example, says that whether Monday's wild gyrations mark the final bang of a global sell-off that started to build last week or signal the beginning of a protracted slump is impossible to know. But on Tuesday, many markets actually rebounded quite sharply, including Japan, and more on that in a moment, except India, which actually fell further, although less, and more on that too. Bloomberg said one thing is clear. The pillars that had underpinned financial market gains for years, a series of key assumptions that investors across the world were banking on, have been shaken, including that the US economy is unstoppable and AI will quickly revolutionize businesses everywhere, and Japan will never hike interest rates, or not enough. All of this actually applies to India too, but obviously in different ways. So how should you be seeing this? Well, whether it is in India or Wall Street, it also goes back to how you've made your original investment decisions and for what kind of horizon, if you've done that. It also depends on what your outlook was. Did you think the stock markets would keep rising forever? Well, if you did, then you were wrong, and then you could be wrong in future too. Now, there are, of course, good reasons to be worried about how things could go. But equally, there's nothing that you can do much about it, whether it's geopolitical tensions or slowing corporate performances thanks to shifting demand cycles. There are some golden rules to investing. Key, of course, is to have a balanced portfolio between stocks, bond, or debt and other asset classes. Now, if you were a steady investor, the last month or so would have looked bad because a sudden cut in import duties has made gold cheaper in India. Internationally, gold is still ruling strong, though down in the last few days. More on gold and what you might have missed shortly. But the lessons of the last few days could be as follows. 1, the stock markets cannot be willed to keep going up. They won't because, among other things, the nature of money is such that people also need it at various points of time, maybe like right now when people are booking profits on the Bombay Stock Exchange. Just watching money grow passively and for eternity cannot be a lifelong pastime. And that is not what institutional investors and fund managers are paid for, which means money will keep rotating. By the way, I do feel sudden falls are actually less worrying than the longer duration flat to steady declines in volumes and levels of the index. Sudden falls, usually driven by speculative bets, also tend to recover, and we're actually seeing some signs of that. Of course, if this sets off something longer term, then it's tough to say, but at this point, there is no change fundamentally, either in the performance of companies in India or the macroeconomic parameters. So that's the reason a balanced portfolio becomes important and is what you should build on whether and whenever you start investing. Strong portfolios tend to weather even longer term dips, unless you have a dramatic event like COVID or the global financial crisis of 2008, which of course I'm sure you know in retrospect were great buying decisions. I can see the temptation to invest in red-hot derivatives or tips with smaller amounts of money because the perception is that losses will be small but gains will be high. Fortunately, it does not end that way every time. So the biggest lesson in some ways is that the jolt can come from anywhere, including currency. Who could even spell yen carry trades until Monday? I'm kidding, but only slightly. We must finally remember that we are living in a cheap or easy money world. The Wall Street Journal says that this may also be the start of a reckoning for a decade and a half of excessive spending and easy money that is going to arrive eventually. Because cheap money, that Wall Street Journal says, is never free and it can't last forever. And it points out that it builds distortions and excesses that are unsustainable and must eventually be addressed. I couldn't agree more. How soon and rough the reckoning will be is, of course, the great unknown, says the Wall Street Journal. Back home, all of this really boils down to do nothing. This is also a good reminder that the vast pools of capital that were pouring into ventures is less because of the genius whiz kids behind them and more because capital itself was willing to take random and wild bets. It's good for everyone, as long as it lasted. And that brings us to the top themes of the day. The stock markets failed to track global market recoveries and poised to stabilize now. The rupee hits a fresh low. If you had invested in sovereign gold bonds in the latest goods and services tax man target, foreign airlines. How pizzas are now India's favorite fast food, though competition is rising.
This is a core report with Govindraj Ethiraj.
Markets and more. The Indian stock market started with a strong rebound with the rest of Asia and then started sliding. The BSE Sensex finally ended at about 78,593, down 166 points. The NSE Nifty 50 was down 63 points at 23,992, but both indices had climbed almost 1.5% each, tracking the rest of Asia, which was much stronger, as we will come to in a moment, before they took a U-turn later in the day. There are some big questions still hanging. First of all, whether the yen carry trade impact is over or are there still more positions that are unwinding? Well, it depends on who you ask. But then, Japanese stocks rebounded sharply on Tuesday with the Nikkei 225, which, by the way, saw its largest loss in the previous session since the 1987 Black Monday crash, was up 10.2% or over 10% at 34,675, hitting its largest daily gain since October 2008. And highest ever spike in terms of index points, according to the CNBC. Wall Street was also strong on Tuesday morning, quoting at least 1% up. So the larger question also, in some ways, is what the US Federal Reserve will do now, and if so, will it do so soon? It was supposed to have reduced interest rates earlier, but it did not, and now there is speculation that it might do reactively rather than proactively. So US data is suggesting a slowdown in the economy and speculation that the rate cut, when it comes, might be too late. Back home, a continuing sign of how traders are jumping into opportunities they perceive is the rise of the textile and garment-related stocks, which surged up to 19% on the National Stock Exchange on Tuesday because of the crisis in Bangladesh, which exports more garments than India, by the way. Business Standard quoted analysts saying that the crisis may provide, however, only a temporary window for gains and that investors should wait for the rally to cool off before adding fundamentally sound companies. An HDFC securities analyst advised caution in the newspaper, saying that the ongoing crisis in Bangladesh means fresh order flow may get diverted to India till the situation stabilizes, but this is a temporary window as Bangladesh remains advantageous on the cost front. The rupee falls again. The Indian rupee fell on Tuesday and closed at its weakest level on record, pressured by a decline in its Asian peers and strong dollar demand, according to Reuters. The rupee hit an all-time low of 83 rupees 96 paise per US dollar before closing finally at 83 rupees 95 paise, which is down from its previous session. Concerns about a US economic slowdown and the unwinding of carry trades that we've talked about have pressured the local currency this week, amongst other factors. Major commodities are also losing ground. We've been speaking largely of stocks, and that's where the attention is, but major commodities like gold, oil, and copper have all fallen in recent days as, among other things, investors start to focus on the demand side. For economies like the United States, higher unemployment also means weaker economic demand. Bloomberg reports that on Monday, copper was down 2% on the London Metal Exchange after falling almost 4%, with aluminum also falling. Crude, which we track here, is also down. It fell about 0.5% after trading down 2.3% at the lowest level in 7 months. So crude oil continues to quote below $77 right now. That's about $76.50 a barrel. A look back at gold. Now, gold prices were rising steadily globally and in India till a reduction in import duties on gold from 15% to 6% or so made it attractive. Remember, import duties used to be around 2% around 12 years ago, and rightfully so. We should be reducing import duties further because high duties only spur more smuggling and the loss of that little revenue that we could earn. Anyway, so here's the news. The Reserve Bank of India announced that August 5th would be the final redemption date for the sovereign gold bond 2016-17 Series 1 tranche, having completed 8 years from its date of issuance and is thus been redeemed. So the redemption price was set at about 6,938 per unit, or 1 gram of gold, also being the closing price as of last week as published by the India Bullion and Jewelers Association, says the Economic Times. So how much would you have earned? Well, had you invested in the 2016-17 series in the gold bond, you would have earned about 122% in over 8 years. The issue price then was about 3,119, or you would have earned 3,819 per gram of gold. So this is a gold bond, which obviously means it's as safe as it gets. And before we forget, the sovereign gold bond also bears a fixed interest of 2.75% per annum, payable semi-annually, and that's taxable for all investors. More GST notices are flowing. The Director General of Goods and Services Tax Intelligence has issued show-cause notices to 10 foreign airlines operating in India for allegedly evading taxes amounting to 10,000 crore rupees, according to a report by the Economic Times. The report quoted officials as saying that amongst the airlines are British Airways, Lufthansa, Oman Air, Emirates, and Singapore Airlines. At a very broad level, the methodology followed here appears to be similar to what Infosys was hit with. The notices sent over the last 3 days pertain to unpaid taxes on services imported by Indian branches from their respective head offices, according to those officials. Now, there are some details to this, but the larger issue seems to be obviously serving of tax notices, which do not seem to have that much prospect of reaching any real fruition, except, of course, to rattle the companies concerned and send them scurrying to lawyers and chartered accountants. A senior official told the Economic Times that the overseas headquarters of these airlines have been handling services like aircraft maintenance, crew payments, and rentals, and the taxman feels that since these services are provided from one legal entity to another, they are subject to goods and services tax, which these airlines have not remitted. There has been some subsequent back and forth on this, with embassies also being brought in by these foreign airlines, but at this point it does appear that the GST department is standing firm. Pizzas are almost 25% of fast food in India and growing. Did you know that pizzas are almost 25% of fast food in India, and they're driving sales of fast food and the growth as well, but there is rising competition too. So the big chains like McDonald's, KFC, and Pizza Hut are obviously big in pizzas and others, but there are also a lot of Indian companies which are increasingly growing in presence, and many of them have over 75 stores each, as Karan Taurani, Senior Vice President and Consumer Industry Analyst at Elara Capital, tells me. He says there are close to 10 large chains with more than 75 stores just selling pizzas, which in turn represent about 25% of fast food market. But the larger reason I was reaching out to him was to understand how he was seeing overall trends in the fast food space, particularly in the last 6 months, both from a consumer preference and behavior point of view, and of course, corporate fundamentals.
So in terms of broad demands, last 6 months, I would specifically say that it's been quite challenging. Post the onset of festive, most of these QSR names or fast food names have seen a decline in terms of SSG, which is in a wide range of 2% to 7%, which means that it's a very troubled time. I don't think we've seen this kind of a sharp decline since the last, I think, about 5 years now. So whatever it is, the situation of the industry is quite challenging. Whether you call it, it's because of the delivery of take, or whether it is because of, Zomato doing well, whether it is because of higher competitive intensity, there could be multiple reasons for the same, but definitely the industry is challenging. One broad trend that we have noticed is that what is dragging this kind of a performance or leading to this decline is the dine-in revenue. So I think dine-in revenues are still seeing a decline of anywhere close to about 7 to 9% for all these players. And that is primarily, because of lower mall footfalls. That's also because of, cinema content doing well, because eventually cinemas are also like a, lever, for better growth in terms of dining within the food court area. And third, of course, too much of, casual dining, too much of competitive intensity in the dining. And of course, lastly, more of take on delivery. I mean, customers are getting more used to convenience-led ordering kind of things. And that's where they're kind of dining out, lesser as compared to what it was. So definitely there's a troubled time in terms of growth rates, and dine-in is a very big reason for the same.
So you're saying that dine-in has been going down by 7 to 9% every year for the last few years?
So on a YY basis, if you see, yes, dine-in SSG, dine-in same-store sale growth is in the range of about 6 to 8% kind of a decline, and this is specifically for players which have a higher exposure to dine-in. If you look at the likes of KFC, if you look at the likes of Burger King, McDonald's, all of them would have a dine-in exposure of anywhere close to about 45 to 50%. So I think that is seeing the pressure. Otherwise, delivery growth rate for all these players is somewhere doing much better. You are seeing growth in that segment, but dine-in is a struggle clearly.
So as things even out between dine-in and ordering out or ordering in, what's the cumulative outcome of this on the way these companies are doing? Again, the major brands in fast food.
Evening out the outcome, as I said, the SSG decline is in a wide range of about 2% to about 6%, and dine-in decline would be in the range of 8 to 12% also for some of the players basis where they are placed. Now, in terms of going ahead, we obviously have the lever of festive, and last year, if you remember, the festive season also was not very great in terms of potential growth rate. So I think this year on that kind of a base, O&D quarter could see a growth of anywhere close to about 3 to 4%. But I think that is nothing wow for the industry, because generally during the festive times, the industry has also grown 5%, 7% on SSG. So clearly, we are going to see an improved trajectory as far as demand environment is concerned. But don't expect a V-shaped recovery. It's going to be more of a steady state recovery. So let's say in the Q1 of FY25, players have reported a decline. I think Q2 will be largely flattish or a small decline. Don't expect like a positive in Q2 itself. So it's going to be very slow and a painful recovery.
Right. So on a cumulative sense, if most of the major fast food companies or brands are seeing declines, even if small, as cumulative, both dine in as well as ordering out. Now, what is driving this? I mean, is it something is it because of other competitive pressures? Is it because consumer behavior is changing or preferences are changing?
I think one is, of course, the environment itself has been tough. As I told you, the points, in terms of why dining as a category or dining as a channel is struggling. Second thing is that, adoption of delivery. So I think delivery frequency increasing massively. We've seen Zomato Gold seeing very strong offtake. In fact, 50% of Zomato's food GOV, gross order value, is coming from the Gold program, which means that the frequency is increasing immensely as far as ordering is concerned. So clearly, I think these are things, which are kind of keeping the growth rates under the check, for the F&B companies, and that will sustain going ahead because people want convenience. And lastly, I think there's also this problem of competition. I mean, the customer clearly is willing to try out new brands, which was not the case about 5 years ago. The customer was loyal to brands like, McDonald's, Burger King, or a KFC. Now the thing is not there anymore. The customer is willing to try new brands. And if at all the experience of these brands are good in terms of, the dining store, in terms of the nature of the store, or in terms of menu innovation, or in terms of the quality of food, there is a significant shift that we are seeing from global QSR chains to local QSR chains. And I think this is also one factor which is kind of hurting the growth trajectory of the global QSR chains.
Let me ask you a slightly more top-down question. So let's say Indian consumers were spending 100 rupees last year on everything. Again, the big brands that we spoke of, their competitors, cloud kitchens, what have you. Are they spending more this year as we stand here today, or are they not?
So if you look at it from that standpoint, yes, the answer would be that yes, they might be spending around 10 to 15% more. But yes, in terms of shares, let's say if global QSR chains of their food wallet share, was around 60 to 70 rupees, that would have come down to a below 50 rupees. So I think incrementally, the global QSR companies are somewhere kind of losing or not able to hold on market share because even the base is phenomenally high for those companies. Whereas the new companies which have started, for example, Good Flipping Burgers, there is Burger Sing. There are so many of these smaller chains which have started in pizza, which is La Pino's. So somewhere on that small base, because of significant expansion, because of being able to piggyback on the aggregators, because of delivery, these players are kind of growing faster.
Got it. We've also seen in the last year or so, food prices go up quite sharply. And within food, vegetable prices, we are holding at about 27% or 26% inflation just in vegetables. Now, that obviously directly impacts all these companies or businesses. So, how is that showing up on numbers or balance sheets?
So I think if you look at the vegetable prices, vegetable that way is like a very small portion of their overall, COGS, or rather raw materials, so to say. I think they are majorly more dependent on the price of bread, milk, cheese, dairy products. And I think thankfully over the last, couple of quarters, we have not seen very sharp inflationary pressures over there. So as far as gross margin is concerned, all these companies have been at a stable level versus last year. And some of them also reported an increase in gross margin. That's because of operating efficiencies and menu innovation things put together. So I think clearly inflationary pressure is not the issue now. The issue now is in terms of EBITDA margins, because clearly despite gross margins seeing an improvement on a YY basis, EBITDA margins have come down significantly because of higher discounting and higher competitive intensity and the value add products to push demand and to drive more customers in the dining facility.
Right. Karan, in the last, let's say, 3 to 6 months, what's the one thing that's really caught your attention where you felt that, oh, here is a new kind of product which could, let's say, to use your terms, wow consumers, or something that you're looking out for?
So I think, firstly, product innovation is very, very important for any QSR company if they were able to, kind of execute well and drive more footfalls in terms of dining. So there have been multiple products which have been launched. I think one very good product which I feel is the fried chicken roll is a very good product. And I think that is something which could be exciting in coming times.
At this point of time in the fast food universe, what's the single biggest selling product by revenue and volume?
So in terms of revenue and volume in the fast food industry, pizza is a significant large market share. Or if you look at the industry as such, pizza market share would be almost about 25 to 30%. That's also because, pizza as a product has seen wide acceptance across non-metro markets, scaled aggressively, and pizza has got at least some 15 players, or rather 12 players who have, more than 100 outlets. So pizza is the most favorite in terms of the fast food category today.
Got it. Karan, thank you so much for joining me.
Thank you, Govind.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.